Today, we will talk about the discount rate and how it is used by the Federal Reserve and in cash flow analysis. The discount rate is the interest rate the Federal Reserve charges commercial banks and other financial institutions for short-term loans. The discount rate is applied at the Fed's lending facility, which is called the discount window. A discount rate can also refer to the interest rate used in discounted cash flow analysis to determine the present value of future cash flows. In this case, investors and businesses can use the discount rate for potential investments. Commercial banks in the U.S. have two primary ways to borrow money for their short-term operating needs. They can borrow and loan money to other banks without the need for any collateral using the market-driven interbank rate, or they can borrow money for their short-term operating requirements from the Federal Reserve Bank. Federal Reserve loans are processed through the 12 regional branches of the Fed, used by financial institutions to cover any cash shortfalls, head off any liquidity problems, or prevent bank failure. The Fed's discount window program runs 3 tiers of loans, each using a separate but related rate. It also allows for emergency credit approvals for banks in distress. The Fed's discount window program runs 3 tiers of loans, each using a separate but related rate. It also allows for emergency credit approvals for banks in distress. Borrowing institutions use this facility sparingly, mostly when they cannot find willing lenders in the marketplace. The Fed-offered discount rates are available at relatively high interest rates compared to the interbank borrowing rates to discourage using the discount window too often. The discount window is primarily intended as an emergency option for distressed banks. Borrowing from it can even signal weakness to other market participants and investors. The use of the Fed's discount window soared in late 2007 and 2008 as financial conditions deteriorated sharply and the central bank injected liquidity into the financial system. In August 2007, the Board of Governors cut the primary discount rate from 6.25% to 5.75%, reducing the premium over the Fed funds rate from 1% to 0.5%. In October 2008, the month after Lehman Brothers' collapse, discount window borrowing peaked at $403.5 billion against the monthly average of $0.7 billion from 1959 to 2006. Owing to the financial crisis, the board extended the lending period from overnight to 30 days, then to 90 days in March 2008. Once the economy recovered, those temporary measures were revoked, and the discount rate was reverted to overnight lending only. The Fed maintains its own discount rate under the discount window program in the U.S. Most central banks across the globe use similar measures, although they vary by area. The same term, discount rate, is used in discounted cash flow analysis. DCF is used to estimate the value of an investment based on its expected future cash flows. Based on the concept of the time value of money, DCF analysis helps assess the viability of a project or investment by calculating the present value of expected future cash flows using a discount rate. In this context of DCF analysis, the discount rate refers to the interest rate used to determine the present value. For example, $100 invested today in a savings scheme with a 10% interest rate will grow to $110. While investing in standard assets, like Treasury bonds, the risk-free rate of return, generally considered the interest rate on the 3-month Treasury bill, is often used as the discount rate. On the other hand, if a business is assessing the viability of a potential project, the weighted average cost of capital may be used as a discount rate. In either case, the net present value of all cash flows should be positive if the investment or project is to get the green light. There are different types of discount rates that apply to various investments of a business. What type is required depends on the needs and demands of investors and the company itself. Here are the most common. To calculate the discount rate, use the following formula, where, here's an example to show how the discount rate works. Let's say you want to determine the discount rate on a certain investment using the following variables. Here are 5 key takeaways. 1. In banking, the discount rate is the interest rate the Federal Reserve charges banks for short-term loans. 2. Discount lending is a key monetary policy tool and part of the Fed's function as the lender of last resort. 3. In discounted cash flow analysis, the discount rate is the rate used to discount future cash flows. 4. The discount rate expresses the time value of money in DCF and can make the difference between whether an investment project is financially viable or not. 5. You can calculate the discount rate in DCF as long as you know the future and present values and the total number of years. Hope this would help. Thanks for watching.